but I like you. Just remember something. Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.
Thought we'd kick that off today because I think that one quote from one of my favorite films of all time, Oliver Stone's 1987 flick, Wall Street, best encapsulates what we're going to be talking about today with Daniel Cannizzaro, founder of fintech Parpera. Daniel, welcome back to the show.
Hi, Steve. Great to be back. Thanks for having me.
It's always a pleasure to connect with yourself, whether it's on a podcast or whether we're just quietly having a friendly dinner or a coffee. Always a pleasure. And the last time you were on the show was a couple of years ago. Parpera, a money management platform for small businesses. At that point in time, you'd raised some capital, over $1 million at that point. You'd started to build your team out. You obviously had investors on board, all that sort of good stuff. You were starting to get some press. Things were moving in the right direction. And of course, we're here today to talk about when things seem to be going one way, but then go a fundamentally different way. And the reason why I wanted to have this conversation is because so many of us today, whether we're entrepreneurs, whether we're corporate executives, whether we're just mom and pop investors, are struggling with a lot of the uncertainty. There's macroeconomic headwinds, there's banking crises. We're seeing startup valuations drop by as much as 90% in some cases. We're seeing share prices of once great public companies being decimated by 50 to 60%. There's a lot of uncertainty going on, but the onus is on us to focus on what we can control to best navigate that. So with that in mind, we know the backstory. Our audience has heard about Parpera before. If they haven't, they can go back and listen to episode 390 from a couple of years ago. But I'd love to unpack at a high level what's happened since the last time we spoke. What are the key milestones that's brought us to this conversation about man staring into the abyss?
Well, again, Steve, thanks for having me back on the show. Look, when we spoke, it was early 2020. Parpera had just been founded. For everyone's benefit, Parpera means fair wallet. We exist to make it easy for people to do business. So if we can reduce the friction and the flow of capital, both human and financial, we believe we can live in a better world and create a better society. When you and I spoke, we were just about to equity crowdfund, and we equity crowdfunded $1 million, ended up raising 1.16 million that year in 2020. We used that to build our initial team and our MVP. And our MVP was a mobile app. It's called the Parpera app. You can download it from the App Store today. It provides people with access to a business account, a business debit card. And then on top of that, we've built invoicing capabilities, the ability to manage your cash flow, to manage your tax obligations. And there's a lot of detail behind it that we can go into, which is kind of outside of the scope of discussion today. But of course, suggest people check it out. We launched Australia's first banking as a service enabled fintech in October 21. We also raised another $1.5 million in capital then from high net worths, a family office, and a fund.
So basically, it raised about $2.5 million in total.
Yeah, it was 2.6, 2.7 by that point. We had a wait list of over 3,000 businesses. We had a partnership with MasterCard, and we had partnered with Rails Bank and Vault Bank. So Vault Bank was one of Australia's first neobanks, or the new wave of banks that were brought to market in 2017. And the significance of banking as a service in Australia is yet to be fully realized. In other parts of the world, it's really enabled the wave of fintechs to come to market. And
banking as a service, Dan, sorry to cut you off there. For the unenlightened, what are we talking about?
So effectively what it means is that a bank provides as a service its access to its license to hold deposits. So the bank holds the deposits, but it gives you access to, from a technology perspective, to plug into that bank via APIs to issue account details and receive funds. It also includes in many aspects the ability to add on a card, and then they usually take care of the risk management and back office associated with providing a banking service.
Okay.
So what it effectively means for any business that might use that type of service is that Parpera is a fintech, we're not a bank, but we can provide people with access to banking services through our app. So when you use Parpera, it's a seamless experience. You don't need to go and sign up for the bank as well. You just sign up to Parpera, and through our app, you're also signing up to the account and the debit card as well. And so it allows you to receive money and send money and do all the things you hope to do with a bank account. We don't pay interest because we're not a bank ourselves. But what it means is it takes that part of the equation out of managing your business away. And so then we focus on what are the tools and insights that you need to better run your business. And what we learned from our customers is that they really care about solving their taxes. They really care about understanding what they're earning and where they're earning it from, and what they're paying and who they're paying and how often, what are the frequencies. And then how do you think about GST and deducting things for tax as well? So we provide all those insights into a really easy to use app.
Mm-hmm.
The fact that we were able to launch then on top of a new bank meant that we didn't need to raise $50 to $70 million of capital to launch. We could focus on solving for the customer problem and the customer experience. And
you didn't need to worry about building all of the underlying infrastructure, essentially.
Correct. So when we plugged into the underlying provider, they then plugged us into the rest of the Australian payments network.
Mm-hmm.
So there were two parties involved in that. There was Rails Bank and there was Volt Bank. We fully launched in March 22. And through that whole time, we were really waiting for those two providers to fix some underlying issues that were stopping us from fully launching. And then eventually in March 22, when we launched our business debit card, we were able to grow our customer base quite quickly from around 100 businesses on the platform to 550 by the end of June. And so that was 80% month-on-month growth. And we're finally hitting our stride. So a lot of the initial assumptions and hypotheses that we wanted to test and demonstrate, we were proving that they were indeed valid. Late June, got a phone call, sort of 8:30 a.m. on a Tuesday morning, telling us that the bank, being Volt Bank, would be losing their banking license or returning their banking license, and that we'd need to shut down our application. And so what that meant was we needed to stop new customers coming on board, and we did that immediately. And then we needed to stop serving. We needed to offboard, which means close the accounts for existing customers. And so these were people that were running their businesses, and it was all working as expected. Now, because Parpera is not a bank, it means that the business itself could still exist, and we do still exist. We had a team of around 13 people then, and we were looking to raise quite a substantial round of capital. But effectively, by virtue of the bank failing, we couldn't offer the account and card anymore, which is a fundamental layer of our proposition. And so we quickly disabled the accounts. We offboarded the customers. We made sure their money was safe. And so we can talk about sort of, you know, the events of SVB, for example, that's just recently happened. And we've lived through a bank failure, and we know what kind of happens in Australia around that.
So just to chime in here, I mean, essentially, to paint that picture, you'd raised $2.7 odd million. You're about 3 years into your journey after launching. You've got a team of 13 people. You've got about 550 customers that have signed up with your platform, that have started making deposits. You obviously had investors on board who had faith in you and what you were building. And then you were essentially blindsided by the failure or the shutdown of Volt Bank. Now, just to humanize this a little bit, I mean, initially when that happened, like the first 24 to 48 hours, I imagine it was a lot of firefighting and just kind of survival by virtue of just doing whatever you can to fix this. And ultimately the fix wasn't an easy one, but how did that make you feel, given how far along you'd come and how much you'd sacrificed to get to that point?
Yeah. So like my immediate reaction was like we were really pushing hard to grow quickly. So as I mentioned, we were delayed to launch, and we wanted to make up for that delay as much as we could. So we're pushing really hard. So my initial when I got the initial response, it was actually at a coffee shop close to the office, and I was running late for the team stand-up, and was just finishing up a meeting, and it was 30 minutes before the public were going to be told about what was happening. And so I sort of ran back to the office, called my partner along the way. I think I've shared this publicly before, but when I shared with her that what had happened, and I think like at that point I shed a quick tear, and And for me, it was more so like thinking about our customers and the impact on them and their businesses, our team and how hard they were working to get to the next milestone. And I knew that in like 10 seconds later, I was going to be walking into the room to tell our team like, hey, like just stop everything you're doing. And I walked into the room in our WeWork office at the time, and you know, everyone was, the energy was like everyone was running as hard as they could. There was like this sense of progress, and it was so hard to just walk in and say, hey guys, like immediately like switch off the marketing, switch off the onboarding, and like this is what's happened. But before we go into detail, let's just take care of our customers first. I'll explain shortly. And that was really tough. And I think the first 24 hours was more just action mode. Like, you know, we kind of understand that things like this happen in the fintech industry, and coming back from the UK before starting Parpera, this had happened there. Wirecard was another big fintech event that left a lot of fintechs stranded a year or so earlier. And so we built Parpera with the notion that we would maybe one day need to switch banking partners. We didn't intend it or didn't expect it to be as soon as what happened there. And so we didn't have any notice. So I guess that was really tough to deal with. Probably the first 48 hours, again, it was really take care of our customers first, then take care of our team and really understand what does it mean for them. So everyone signs up to a startup journey for different reasons. Some of us kind of had like another go in us, and some of us sort of said, yeah, I've given this everything and I've already been through a bunch of setbacks over the last 2 years. The next part's maybe not for me. And so once we took care of our customers, we kind of sat down with the team, one-on-ones with everyone, and said, okay, look, it's probably going to be another 6 to 9 months to get live again. This is what the journey looks like. And you know, with that came opportunity for some people that maybe didn't see the start of the journey got to see it. And then once that was kind of done, we all went on leave actually for a 2-week period once we'd sorted everything out. And that gave everyone just a bit of time to refresh, and then became the path of so we identified a new partner pretty quickly, and we're very close now, I'm happy to say, to go live again. And so I'm sure we'll cover that later in the discussion. But you know, there's that, we spoke about the abyss earlier, and you know, what it reminds me of is actually the very start of the journey. So we speak about, you know, how hard it is to get started in entrepreneurship, and you and I connected back in 2019. And I would say there were periods where, you know, it's just you and an idea and nothing else. But I think there's something very powerful in that. So we serve business owners. And for me, this whole event helped me empathize even more deeply with business owners. And you know, we're really lucky. We're funded by investors, and we were lucky to still have $1 million in cash at that point in time. So we had capital to rebuild, despite the financial market starting to turn at that point. We had the chance to come back to market. Whereas for an average business, if something like that happened, they'd probably go out of business straight away. So I'm very grateful that we had that opportunity. But I guess for me, it also helped me understand even more so than before that running a business is not a 2 to 3 or 5 year pursuit. It's a long game, and you need to treat it that way. And so sometimes it's a marathon, not a sprint, to put it simply. But yeah, I'm sure we'll unpack this a little bit.
Yeah, of course. And I mean, you mentioned that you gave your team a couple of weeks away, a couple of weeks off to kind of refresh, reflect on what had been, and then come back, have a conversation about, you know, who's in this for the long haul. I guess in managing team morale for those who decided to stay on, because, you know, human beings, we are chemical creatures. You know, we get dopamine hits when we're seeing progress, moving towards a milestone. And I know from experience that when I've been working towards one milestone, whether it's in business, whether it's in, you know, romantic pursuits and things of that sort, when things fall apart, it can be very demoralizing. You can start to question why even bother. You know, you can go to a very dark place. So keen to unpack how you not only, you know, dealt with that yourself, but how you try to inspire confidence in your team after the unexpected setback of Vault going missing.
Yeah, so like firstly, I'm really lucky to have a good team, like and we've built a very strong culture. So and we really have a culture of trust and transparency. So we openly communicate, and even we did that. The first thing I did after telling the team, like, hey, this thing's happened, we've got to go and split out and do all these different things. Crisis Management 101 was communicate to the public. So that was the first thing I did, was sit down and write a press release. And but from how do we So I'll start with myself first, because I think as a founder, the conviction to continue really comes from you and or as a business owner. And if you don't have that conviction, then no one else is going to follow you. It's very simple. And the only reason why the business exists today, and any reason why any other businesses that people run exist, is because that person, that individual that starts the business, has a strong level of conviction that they want to do something or see an opportunity and are willing to persevere. So if you're not willing to do that, you're probably not going to get off the starting line. And if you do get off the starting line, well, it's not going to take long before something hits you in the face and you have to like kind of work it out whether you're in or not. For me, I'm super passionate about what we're doing. So I've had a global consulting career. I've been fortunate to study at a very good business school overseas. I've experienced what we're building. I've lived with it. I lived through it. And both from being an enthusiast in the industry, but also a customer of a similar proposition in another market. So I know the benefits myself. I grew up in an Italian migrant family with tax returns around the dinner table. I talk about this often now. And so for me, like I understand the pain of running a business because I've seen my parents run their own business for many years. I understand the pain of running my own business. I understand the complexity and the inner workings of the financial services industry. So I understand how things are built and why things aren't built the way that actually are designed for people, but more so to design internal metrics. And so it's like in consulting, we used to talk about like, what are the 5 things that the customer wants to interact you with rather than 150 things that you do internally. And a lot of organizations that focus on 150 rather than the 5 simple things. Parpera is all designed around how do we help you as a person that is a business owner. And so for me, it was a deeply personal pursuit to keep going. And so, you know, at the same time, I also revised all my thought internally, like, what are my trade-offs? What's my opportunity cost? Because I'm in a very productive phase of my life and career. I turned 35 this year. This is my time to really create something in my life, because kind of you get a good 10 to 15 year period where you've gone through that steep learning curve, and now you can actually really take risk and create stuff and create a lot of value. And so for me, it was like, well, how can I create the most value and have the most impact? And assuming that there was a way back to market within our cash runway, then there was no reason not to keep going. And we found another service provider to help us pretty quickly. And we knew what the timelines were around that. So that afforded us a little bit of time to take a break and just reflect. And then with the team, it was a similar conversation. It's like, all right, this is what the experience can be for you over the next 12 months. This is what the risks are. But if you're willing to sign up to that journey, then we've seen what success looks like, because we saw the early stages of it working. So we know that if we just get it working again, that we can have another shot at doing this. And in that time, we've also built a whole bunch of new functions and features that weren't existent before. So what we relaunch will be way better than what we had. And so we've got the benefit now of almost 2 years of development. We turn 3 next month as a company, but we've had about 2 years of actual software development. And so when we relaunch, you'll see a very different proposition to what existed before, a much more powerful, comprehensive solution. And so for me, that gives me a lot of confidence. And so hopefully that sort of shares a little bit about it. But with the team, it's around trust, transparency, and just being very open about what's the opportunity and what are the risks. And fortunately for us, people were willing to sign up and keep going.
Well, I think the lesson that I take out of that really aligns with some of the work out of various schools of psychology and even Angela Duckworth's book, Grit. It's one thing to say, have grit and be resilient and push through difficult times. But the research shows that when you actually have purpose in your work, the likelihood of you having grit and pushing forward despite inevitable setbacks that you will face in the world of entrepreneurship are something like 6 times higher. Because if you truly believe in what you're doing, if you're also passionate about it, if it gets you up in the morning, then you'll feel crap for a while. There's no doubt, you are a human being, but you're more likely to say, okay, well, what can we control? How can we get this back on track? And you will do that. But if you don't truly believe in what you're doing, if you're only in it for the money or the status, you're probably going to say, well, how else can I make money? How else can I get some status? And, you mentioned yourself, you went to a prominent business school overseas. So that was London Business School. You got your MBA there. You spent many years working at EY. And if it was purely just about, well, how can I extract value from society and add more zeros to my bank account? you'd just go back into that consulting world with EY or some other large consulting firm, and that would be, that would be it. That's the easy solution. But you're not driven purely by making money. You're driven by purpose, passion, and you want to make the world a better place for business owners, essentially, and make it easier for them to just focus on their business and providing value to their customers rather than focusing on the day-to-day administrative stuff that can consume a lot of time and energy. So we've touched on employee morale, but when you are a early stage startup founder, you've got other key stakeholders. So in this case, you had 550 odd customers who you needed to, of course, communicate with, but you needed to manage those relationships. And you also had investors who had plowed $2.6 odd million into the business. So aside from writing a press release, I'd love to understand and unpack how you went about managing those relationships with stakeholders, be they investors or customers, and what that looks like today.
Yeah, so I mean, what we experienced was effectively, what could be termed as a black swan event. It was an event that statistically would not have been really expected to occur. Now, Australia has had 2 bank failures within a short period of time, largely controlled in the sense that they were new banks and APRA was monitoring them very closely. However, all signals that we had was that things were on the right track. But from a technology perspective, everything was going the right direction. So there were some things that we needed and they were coming. And from a metrics perspective, in terms of monitoring our partners, it all looked okay. So when this all happened, when we communicated it, firstly, our customers were really good about it. They, the amount of messages that we got was heartwarming, and part of the motivation to keep going as well is that they loved what we had built. And we keep all these messages to remind ourselves of the value we're adding. And so the sentiment was, we'd love to have this back. Please, rebuild it.
Was this something that? Sorry, Dan. Was this something that you looked at when you first started raising capital in terms of doing reference checks with other entrepreneurs? Like, what's this investor like when the going gets tough? Do they still support you? Because there are 2 schools of thought with VCs. One is that you focus your energy and efforts on the winners and, forget the rest. Let's just focus on propping up the winners. And the other school of thought with many VCs and investors is, well, the winners are going to win regardless. Let's help these other guys who aren't, going as well. Everything's not going swimmingly for them. Let's prop them up. Was that something that you took into consideration up front, or were you just lucky enough to have people believe and invest in you who really do buy into the mission and therefore are willing to stand by you despite this black swan event?
Yeah. So my reference was to customers that we were serving in terms of the feedback we got. From an investor perspective, it was very similar as well. It was more so sorry to hear that this has happened. We didn't have a single investor reach out and say, hey, what have you done to my money or anything like that. There wasn't anything hostile as a result of what happened. I think there's an acknowledgement that it was largely out of our control, notwithstanding that that's not an excuse. But again, sentiment of support to say, we back you, keep going. And so ours was more the latter, where people were willing to back us to keep going. Even today, we still have strong support from our existing investors by way of just regular communication, regular introductions to networks that can help us and other investors as well. And we haven't brought on a top tier VC fund on our cap table. The Australian fintech sector is still developing in its maturity by way of early stage investors. So it really starts to pick up in terms of that Series A level. But for the pre-seed, seed stage, you're really looking at international funds, and to access them, you kind of need to be live in market for a couple of months. So we relied on equity crowdfunding to get started. Then we relied on high net worth individuals. And now we look at kind of a mix. And now the funding environment's changed significantly as well during this time. So, we were speaking about business cycles earlier and how there's a bit of, a lot of uncertainty. We find that the best way to manage all of that is we just communicate progress. We continue to gather support, but until we reach our next milestone, which is go live, that's going to be the next catalyst for an investor discussion. And we're already starting to have those discussions now.
Yeah. So one thing that comes to mind is this concept of surrogate metrics, when you're moving towards a goal, but there's no real measurable progress. Like this, it's not like we have 1,000 customers on board, because right now, like you said, you just got a new partner. There is a process to follow in order to get to that place when you can start onboarding new customers and taking deposits and all that sort of stuff. And Scott Belsky, who founded Behance, he sold it to Adobe for several $100 million. He coined the term surrogate metric, which is, well, instead of focusing on these long-term goals, what are the things we can focus on in the short term to maintain team morale, to keep us focused, to give us the confidence that we are moving in the right direction? Is that something you've looked at? And if so, what are some of those surrogate metrics?
Really interesting. In a previous life before entrepreneurship, I used to be a really long-term planner. So you say, okay, here's my 5-year plan. Here are the things I'm going to do to get there. And if you're dealing with traditional environments that are structured and require X, Y, Z to be ticked off before you can progress to the next stage, that's really important. You need to do that. And I'm still a big believer in having a North Star or a roadmap of something you're working towards, because usually great things take time to achieve, and you can't just show up when you decide to do that thing. There will be a barrier to achieve it. In our world, where things are volatile and they're changing quickly, and I don't mean volatile in a negative way, it's just they move fast and things change very quickly. There's no point planning beyond like the immediate horizon. It's important to have a North Star and to have like a direction, and we do have that. We know exactly where we want to go and where we want to be. But the day-to-day on how we get there needs to adjust to how we react to new information. So, for example, for us, the number one goal right now is get live. That's it. Anything beyond that is great, but until we get live, nothing else gets unlocked. Now, there's as mentioned, there are fundraising discussions. There's production testing happening right now. We're licensed, so all those things are little milestones along the way, which we focus on and celebrate internally. So if you think about all the different parts of a business model and what you can de-risk, we've now, since last July, de-risked most of the things. And the last final thing we have to de-risk before we go live is complete production testing and launch, and notwithstanding potentially fundraise as well.
Yeah.
And so that's how we think about it now.
Yeah, that makes sense. And you mentioned that we are facing a much more difficult funding landscape at the moment. We've seen SaaS companies in some cases with valuation multiples of 50x revenue come right down to say 6x revenue. So like 80, 90% markdowns. Are you in a position now where you're still kind of working your way through the existing capital, or have you started looking at fundraising again? And if so, how have you found the current climate?
Yeah, we still do have existing capital, and we are fundraising. So we are having investor discussions now. As I said earlier, the fintech investment landscape in the early stage has always been difficult in Australia.
Yeah.
And so we never had the luxury of raising large amounts of money at high valuations at the very start. It wasn't, and you couldn't raise without a business model like you could potentially do in other markets in terms of path to revenue. And so the discussion about path to profitability that is in focus now is something that we always had to think about. However, I will say that the horizon to profitability has come all the way forward. To investors have a preference for companies that are profitable already. They tend to refer it to as default alive. But we're still seeing appetite for people in terms of to invest. What's really changed is sort of the valuation they're willing to invest in, and that they're ongoing discussions. So price discovery per se takes a little bit longer in this market because at the early stage, particularly, you can't rely on revenue multiples. So it really comes down to then the view that fund takes and how they're going to value you as well. So we're still having those discussions. Yeah,
fair. And I think based on what I've seen in the market for seed stage, pre-seed, even up to say some Series A startups, like the valuations haven't been hit as hard as they have, say, for Series C, D, E startups, because the horizon to exit is a lot longer. So in the current market, yeah, fair enough. Like if it's a late stage startup that's hoping to exit in the next 2 or 3 years, then investors are going to take that on board. But if it's potential exit 7 to 10 years from now, then the current market landscape doesn't really matter as much. And we're seeing seed valuations not really being hit anywhere near as much as those late stage valuations. But ultimately, there's less money splashing around because there's a lot of uncertainty, and people who are investing, whether it is in early stage, whether it is in late stage, particularly venture funds, they're having to rebalance their portfolios. And a lot of LPs in venture funds are finding that they're currently holding a lot more venture assets relative to, say, stocks and bonds and property, just because those other types of assets can be marked down immediately. Whereas with venture, it's private. So there's no immediate markdown. So what was maybe 10% of your portfolio is now 20%. And so LPs are looking at that and saying, well, I'm not going to invest into any more venture funds, which could have a flow-on effect on funding down the line, which doesn't really bode too well for what is already a somewhat challenging funding market for early stage startups, in particular fintechs here in Australia. Yeah. But building on that, I mean, we are seeing a very uncertain and challenging macroeconomic landscape. So putting aside some of the very unique technical challenges that Parpera has faced in the past year, I mean, we have seen Disney just yesterday announced that they've laid off 7,000 workers. They shut down their entire metaverse division, which is crazy to think because 12 months ago, everyone was talking about metaverse. Facebook is obviously culled their metaverse division significantly, even after changing the name of the company to Meta. Last year, there was 140,000 US tech employees laid off. This year, as of March, so 3 months into the year, 100,000 tech employees have lost their jobs. We've talked about markdowns. We've talked about market caps of public companies being absolutely decimated. Keen to understand what steps you're taking to not only navigate your own unique challenges, but also the broader macroeconomic uncertainty.
Yeah, so three points. First is just on touch on seed stage, early stage valuation. So Carter, a large US-based platform, has recently released 2023 data on what those multiples look like. Seed and pre-seed have actually increased in value despite the macro environment, and all other stages have decreased. So I'll just leave that point there because there is data to show that at the pre-seed and seed stage, valuations are still pretty healthy.
Yeah, I think AngelList published something similar on 2022 valuations increasing on 21 as well. Yep,
exactly. But in terms of our own focus, we've refreshed our whole business model to focus on profitability within 18 months. So we can't just switch on the profit tap and say, hey, like we're default alive. That's just not our business model or how we exist. Nor should it be, by the way, because as I mentioned, to deliver a banking service, you need $70 million of capital. We've raised 2.6 million, and we're still going to give people a proposition that gives you access to an account and card. Mm-hmm. So we're still doing it at a fraction of the cost, but there's still significant upside to go. So we are taking a view that we will look to raise and then use that money to potentially get to profitability or raise again and get to profitability not too soon after. And we believe that's the right thing to do. So we believe that you need to take a view in this climate that you need to be revenue generated from day one. You need to understand your unit economics, and they need to make sense. They need to be able to scale in accordance with your customer base, and your cost to serve needs to come down pretty quickly, and cost to acquire needs to come down pretty quickly as well. In terms of global outlook, I think, Steve, the reality is that the global economy and sentiment, it got pretty crazy towards the end of 21 and in 22, in the sense that people were willing to invest in anything. The cash rate was zero in most developed markets in the world. So people that wanted to get exposure to risk and therefore earn a return needed to find opportunities that they could invest in to realize that. The cash rate now is, I think it's 3-point-something% in Australia, and in other developed markets, it's also been increasing over the last 12 months.
It's about 5% in the United States at the moment.
Exactly. So if you could park your money in the bank and earn effectively a 3 to 5% return, depending on which market you're in. And if you've got exposure to some bank grade bonds, you're probably getting a little bit more. And so the need to take risk has come off. So we're in a risk off environment, and investors can earn a reasonable return by not taking that risk. That's not to say, however, that opportunities don't exist to still make those large venture capital size returns. We're just seeing people be a little bit more cautious around the deployment of capital. So that capital is still there to deploy. I don't have the exact statistics, but from the discussions that I've been having, there's still a lot of dry powder out there that still needs to be deployed.
Yeah.
Now, in terms of when I take a lens from a general business perspective, and this isn't advice by any means, but if I am a business owner, if I was a business owner, you need to take a real strong focus on cost and control your costs. So we've looked at every cost in our business to try to get that as low as it can be. And we take a really strong view on sort of managing that.
So did that involve having to terminate employees that wanted to stay with Parpera?
Not necessarily. We didn't take that approach. We have had to make adjustments to the team size. So we were 13 people in June last year, and we're now 5 people. And so, but we reduced the team to the core that was required to run the business. So for example, we didn't require a customer service and operations person anymore, because we didn't have any customers to serve and we didn't have any operations to run. So unfortunately, that was one of the first roles that we had to let go of. We've retained the core team. So we've got a product manager, a front-end engineer, and 2 back-end engineers. And that's what we need to get to the next stage of the business. Once we're live, then we'll focus on service and ops and marketing type roles, but we don't need that right now. So we focus on exactly what we need to get to the next stage.
No, that's fair. The reason I asked that was more so to understand whether you had to have any difficult conversations with people that had been there more or less from day one and really believed in the vision and wanted to be a part of it long term.
Yeah, there were some conversations that I had to have that were difficult. But again, everyone understood that this was out of our control. So we're just trying to make the best out of the situation we're dealing with, and that's all we can do. Yeah. And so as long as we're reasonable in our actions and we're clear and transparent and we can maintain trust, those conversations are more collaborative as opposed to hostile and it doesn't invoke a defensive stance. It's more so, all right, I get it. I understand why we need to do this. And so
I think that's a big part of just recruitment in general, like finding people that are aligned with the values of your organization, that, welcome radical transparency, are self-aware and so on. And so that when you do inevitably, in many cases, have to have some difficult conversations, they're better received than they would be if you had hired people whose values were just in conflict with Parpera's core values.
Values and culture, I would say, now that I've been running this business for close to 3 years, is the number one thing to get right. You read it all in the literature, people talk about it all the time, but it is super important. And if you're part of a large organization, it'll get spoken about quite often, but it's harder to influence that. When you're part of a new organization or you've just created an organization, you need to create that culture and the values that you want to see. And a lot of those stem from you intrinsically. It's very hard to say that you do something but if you don't do that naturally, it's very hard to actually instill that value in the organization. So you actually just do what you say your values are. And if you don't, people won't learn those values or act in a way that
culture,
they're meant to.
Culture is what you do, not what you say.
Exactly. So we, and I would say that the culture we have today is far more mature and the expectations are very much aligned. When we were trying to grow the team really quickly, we were focusing on what are the key, we knew that culture was important. So everything that I just said, we knew back then. But what we did, because we were reacting to market pressures or growth pressures, is that we kind of said, okay, we've got to get this person like today. And we'd rush the recruitment process and we put the person in. And then, either we had not, because we had a couple of mishires where either we didn't pick something up through the recruitment process or they didn't necessarily know what they were getting into. And then sort of, it's a startup environment, sort of environment where these things get found out really quickly. It's either it works or it doesn't work, and there's nowhere to hide.
You're not hiding behind 200 other people and countless meetings.
Correct. That's right. So it's really simple in that sense. And now what we've learned is that we're taking a different approach to how we build the teams today. So we're actually not looking to aggressively expand the team when we launch. We will very selectively, very carefully add people on once we feel the pressure of needing that person. So we won't hire in advance of the wave. We'll hire once the wave has sort of hit us. And the reason why we'll do that is because in startup land, that wave may never come. And you don't know what that wave's going to be like. And so whilst we could talk about how many people we need to serve X or Y number of customers in Z number of months, I would rather see that growth and have me answering customer phone calls before I hire a customer service person to serve a customer that may not be there yet. So, and
And
that's
there's
in
also
response to
value
really-
in that too. Like there's value in you being on the tools because you can learn firsthand from having conversations with customers in a way that
Yep.
perhaps a hired gun wouldn't.
If you go to our website and write a request, it's highly likely that I'm the guy responding. There's one of the other ladies in our team may respond, but
Yeah.
I like to get on the tools, and I do like to speak to our customers. It's a
Yeah.
really important part of being an early stage business owner.
Yeah, well, I think it was, and I may be misquoting or misattributing this, but it may have been Paul Graham at Y Combinator who said, in the early days, do things that don't scale, like taking customer calls, because they're the things that are going to help you gain an inside edge in terms of how your customers think, what they want, what problems they're navigating, so that you can incorporate that into the business, build some of those ambassadors into your followership and grow from there. Of course, when you have 1 million customers, and there's calls coming through all day long, it's going to be harder to do that, but you still could spend a little bit of time having those conversations, and some more prominent, mature founders do exactly that. Like they
think it's super important to always have to always have the pulse of the customer, for lack of a better expression. I think that's actually what's lacking in developed organizations, that the people at the top making the decisions don't really know the customer anymore.
Yeah, it's funny though, like you have a lot of these voice of the customer roles at large corporates, and it's really just a hired gun who comes in. They're paid maybe high 5, low 6 figures to allegedly be the voice of the customer, but that still is subject to the principal agent bias. Like that person's interest in knowing what customers want versus, say, shareholders if they're a public company, or the founders if they're still private. It's going to be pretty different. And I guess in a lot of smaller private companies, what we do see is, say, sales reps who spend a lot of time talking to customers, reporting back, having some sort of formal process in place where they report back to marketing, where they report back to product designers, founders, basically anyone who could use that information to improve the product over time.
Yeah, Steve, all I will say for your listeners is if you're a founder and you're a business owner, you should never engage, at the very early stage at least, I'll caveat with that, an external consultancy to go and learn about the customer for you. So it's okay to get people to do research on your behalf, but you need to be in the trenches as well. I recently heard a founder pitch and said, we had insert big consulting name here, do market research and tell us that X, Y, Z. And in my mind, I'm like, you should not be using a big consultancy, particularly at the early stage, because they're expensive, to do your market research. You should be doing it yourself. Like you should understand the market, and you should know the difference between different products and offerings, because if you don't, then no one's going to know. I mean, a lot of investors, when they come to assess your proposition, very few look really deep into very few of them are actual users of competitive propositions. So they're forming a view on perceptions and how well you're managing those perceptions. And but if you're a founder and you want to build a great business, you really need to understand the problem you're solving, the customer you're serving, and beyond
Absolutely.
that's the first point. Like you can't go any further if you don't get that.
So it's funny, you mentioned earlier, when the business is growing, you feel this pressure to hire, and sometimes that can affect the amount of due diligence that goes into some of these hires. And that's something I totally relate to. And we saw this play out in the last couple of years with venture funds investing, because there was just so much dry powder, and there was just so much money being plowed into startups at crazy valuations. Deals were getting done in a matter of hours as opposed to a matter of weeks. And a lot of top tier venture funds were just not doing their DD. They're just saying, well, if we don't do it, then that mob down the road are going to get in and lead these deals. So, and that's partly why we saw these sky high valuations. And a lot of these funds that invested in, these vintages of 2019, 2020, 2021, their returns are going to be absolutely decimated. So I guess there's perhaps a lesson in there on, it's a hard one. There is no easy answer to that. But when mob mentality and FOMO prevails, proceed with caution, because there's a reason why things like due diligence exist. But speaking of due diligence, now we've seen a lack of due diligence at banks like Silicon Valley Bank, which you mentioned earlier. In their case, they were holding on to long-term bonds, and due to these interest rate increases that we saw, due to the difficult funding landscape, startups withdrawing their funds, this led to them essentially becoming insolvent. And of course, there was very influential people like Peter Thiel at Founders Fund saying, hey, if you're in SVB, pull your money out, not really helping the eventual bank run that has since claimed several other banks. Signature Bank is another one. We saw Credit Suisse get gobbled up by UBS for several $1 billion. It's a difficult it's a difficult macroeconomic landscape. And this quote unquote banking crisis, I mean, we're seeing people pull out their money out of smaller regional banks now in the United States and just put that into the safe quote unquote hands of JP Morgan, Wells Fargo, and the big four American banks. Now, this has created a little bit of a negative sentiment in terms of smaller banks. And I know Parpera is not a bank, but many people may see it as such. So what are your thoughts on this global banking crisis, the stigma it has created around smaller banks, and how this may or may not affect the customers' perceptions of Parpera?
Yeah, so that's a complex question. So, and I'll try to answer in the easiest way with the time that we have. But I might go back to front. So, firstly, yeah, as you said, Parpera is not a bank. We have a banking partner, and they are regulated by APRA, and they have capital requirements. So they need to hold a certain amount of money for every dollar of customer money they hold, and that's safeguarded. So they have to safeguard the funds, and APRA enforces that. So that's point number one. So the funds are safe. The Australian banking market is very different to the global, multi-jurisdictional complexity that we're talking about. So in the US, particularly, a market that is known to have a higher risk appetite, the macro environment acts in cycles, right? So there are different commentators saying that this is not like a 2008. It's maybe more like a Great Depression or some other 10 to 12 year period in between that this repeats over and over again. So I think it's very difficult to comment on sort of what might happen. But if we look at history, what could happen is that there will be some consolidation. The market will calm down. But I think what we'll see is banks and government work together to provide confidence to the everyday citizen that their money will be safe. There is no economy that can afford to have a loss of trust in the overall system. It would be so. I think a personal view, again, not advice, nothing you should rely upon, is that in Australia we should be okay by virtue of the evidence that APRA has shown in terms of how they acted with Vault Bank, who was our previous partner, and Zinger Bank, which was another neobank that was shut down. They don't let the risk accumulate to levels before something catastrophic happens. Generally speaking, at least that's the evidence from those two use cases or case studies. But and I believe just earlier this week, both APRA and some of the bank CEOs came out to reassure the public that the money's safe. So I think we shouldn't see it. It shouldn't be as bad here. Yeah. But I'm not close to the inner workings of the US banking system right now, so I can't comment on what we see there.
That's fair. And I do recall back in 2008, there's mortgage-backed securities that led to the great financial crisis. Like, you had apparently dogs who had taken out mortgages, and you had countless people, these ninja loans, no income, no job, no asset, being able to just take out a several $100,000, if not greater, mortgage on a house, which is something
I apologize to interrupt there, Steve. You asked about sort of the Parpera piece, and I think it's a really important point on lending. So Parpera doesn't lend customer funds. And so when you deposit money into an account that's with our partner bank, we're not lending that, and our partner doesn't lend either. And so those funds aren't going anywhere. The way traditional banks operate is that they take $1 from a customer and they fractionalize it and they lend it out. And so what happens is, when you get a run on the bank, what that effectively means is that customers are asking for their deposits back faster than the bank can get the money back from the people that they lent to. And that mismatch in what they call liquidity is what causes the crisis.
Yeah, absolutely. Yeah.
And
so
that's effectively.
Yeah, definitely that's not part of your business model. We understand that. So in the little time that we have left, I think I'm going to throw 3 yes or no questions to you. So the first question, what we're seeing today in the macroeconomic landscape, in particular over in the United States, large foreign debt balances, we're seeing civil unrest. This kind of stuff in the past really preceded the fall of empires, whether it was the Dutch guilder being displaced as a global reserve currency, whether it was the British pound after that. And now we've seen the United States dollar since about the 1960s. It's been the global reserve currency. Yes or no? Do you think that in the next 20 years, the US dollar will lose its reserve currency status?
Possible.
Not a yes or no, but fair enough. Fair enough.
It's the best you're going to get.
It's a bit of a cop out, but I'll take it. Now the next one, given this reality we find ourselves in, certain people like Balaji Srinivasan, who's a former CTO at Coinbase, he was a general partner at Andreessen Horowitz for a little while. He's become a big spokesman and ambassador for Bitcoin. He thinks that Bitcoin will hit $1 million in the next 90 days as a result of all of the, say, lack of confidence in the US dollar. Yes or no? Do you see that happening?
Don't know, so I'm going to have to go with a no.
Fair enough. This was not the right game to play, but this last one you can give me a yes or no is, are you using any generative AI in Parpera at the moment?
Yes.
Yes. Okay. What are you using it for?
So we are automating the ability to do business activity statements. So we've created a bot that we call BazBot, for lack of a creative term. It's Baz with a Z.
Yeah.
And BazBot will take the transaction data.
It's very Australian, by the way, Baz with the Z.
Well, we serve.
Surprised you didn't call it Bazza with 2 Zs.
Hey, Bazza. Yeah. Go a bit step further, but we stay classy at Parpera. Yeah. So look, the opportunity for us is that we take what used to be in a banking platform, and we can take parts of what sits in a big accounting platform, and we bring it together to do the simple things that you need as a business owner, not as a finance manager, not as a financial wizard or professional in anything to do with finance. We just want you to be able to focus on what matters most to you. And where we see the use case for using intelligence is through taking your transaction data, playing it back to you to confirm a few things that are important as part of the process of preparing that report, but really minimizing the inputs to really control the quality. And then we'll give you the business activity statement, which you can then lodge. Or if you don't want to lodge it yourself, we'll pass it on to our accounting partner and they'll lodge it for you.
So what about in terms of the back end? So sales, marketing, content marketing.
Yeah, we use it internally as well. Yeah. So we do a lot with it internally now. So everything from copy to phrasing, to product positioning, to brand, we come up with the ideas, we use it to refine the ideas. We used it to create a script. We've used it we use it for some coding troubleshooting as well. We're very careful about what we pass into the tools because we are conscious about IP and what might happen as a result of getting. So we use it for snippets instead of like entire code base. We'd never do that.
So just on AI. Yeah. Just on AI, I mean, there's a term going around at the moment. It's trending on Twitter, AI anxiety. Now, people from across the professional gamut are feeling this in some way, shape, or form, which essentially just, at its core, it's about the fear of being replaced. It's about the fear of being insignificant, particularly when we derive so much identity from our work, from creativity. Do you have any AI anxiety, Daniel? If so, why? If not, why not?
No, I embrace AI. My first startup actually was an AI tax advisor. I wanted to automate tax returns. The technology wasn't mature enough yet. It was back in 2017. No, I see it as an opportunity. So it unlocks productivity. And so where maybe me I may have needed several hours to spend on something, or I may have needed several people, it kind of like augments me and the way I think and to do things. So for me, that's super productive. Now, for wider society, where if I was in a role where I was responsible for a very specific function that could be possibly at threat from being automated or consolidated, I can see why I would feel threatened or scared or anxious about it. But I think, and I empathize for people in those roles, because the world is changing very quickly. So it's not their fault. But I think the more overarching lesson here is that to be successful today and in the future, you need to learn. And if you don't know how to learn, you will unfortunately potentially get left behind.
Yeah.
And so that's going to be a real challenge for society, because we can't have mass parts of the population left behind, and it will cause policy shifts and things will happen to make sure that people are taken care of. That it needs to happen. We can't leave big percentage of the population underserved or without jobs. So there will be structural shifts. Some of that may be uncomfortable. I don't know what that's going to look like. There's a lot of theory out there. But I think to protect yourself in being on the right side of history, you need to learn and be willing to embrace the world as it is and not what it was. And I know, conscious of time, Steve, but this is no different to when cave people went from hunter-gatherers to storing grain, and then fast forward to the invention of the industrial revolution, when we started using factories. And then fast forward even further when we went from like paper to computers. This is just that next shift. It's just happening a lot faster. And so if we reflect on the last 20 years and how much the world has changed, people can't change as fast as things around us are changing. In fact, our brains haven't even evolved as quickly as what the world around us has evolved. And there are other sort of psychological impacts of that at play as well, which we won't go into today.
Yeah.
But, so I think it's an exciting time to summarize. I think we should embrace AI. I think the people that are developing it are going to have to be very careful about how we embrace it. But despite whatever I might say today, it's happening. Like it's, we could say that it's bad. We could say that we should, you should ban it. The reality is that it's already here, and it's only going to keep going.
Yeah, absolutely. And I think what you're alluding to there with our transitions from being hunter-gatherers to farmers, from farmers to industrial workers, is the productivity paradox that usually follows these big transitions, where a lot of people find themselves out of work or making a lot less money than they were previously. And these are very challenging things for governments in particular to have to try and manage. And so I don't envy anyone who has to do that, because it is going to be a difficult time. And it also is something that does also intertwine with the fall of empires and the dislodging of global reserve currencies, which is an interesting topic. But
Ray Dalio's Changing World Order is a great piece of literature for anyone that wants to learn a little bit more about the different empires and triggers. And I think you've touched on that topic. We haven't gone very deep in it. It's for some people it'll be quite controversial to discuss, but there's something there, something definitely happening. My final point on sort of AI and the changing economy that we're in, I think what we're going to see is more entrepreneurship, either willing or forced. So people will need to find ways to continue to live and to generate income to support that. Going back to what our mission is at Parpera, like if we can make it easier for people to do business, we can help people through that transition. So I think people will embrace entrepreneurship. I think it will be encouraged because companies are unlikely to need to employ as many people. Because they'll be able to do things as much more efficiently. And equally, once you learn how to run a business or have some sort of trade or vocation or service that you can provide, it will be easier for you to set up a business, because there will be tools out there that enable you to do it way easier than what it ever was before. And hopefully we'll be part of that as well.
Yeah, and I think just on more businesses being generated and more entrepreneurs coming out of this AI boom and the displacement of many jobs, I think a good parallel for that was COVID. I think just looking at an article now, there were 34,000 new businesses signed up with ASIC. This is in the first 6 months of 2021, compared to about 11,000 for the comparable period. So it was like a 3x increase.
Yeah, so here's another stat for you. It's so on average, sole trader cohorts in terms of Australia have grown around 2 to 3% year on year. In the last 12-month period that they reported on, it grew 12%.
Yeah.
So we had this explosion relative to other years of sole traders.
Yeah.
And so what's driving that, right?
Absolutely.
And I think we're going to continue to see that happen. And I don't think our institutions and the frameworks that exist within our society today are really set up to support that. And so what we're going to see governments shifting even quicker to try to support that shift in the way people work. And it has huge implications for the relevance of superannuation, because a lot of business owners don't pay themselves superannuation. So what happens to them at retirement? Property affordability, people getting on the property ladder later, will they be able to pay off their properties by the time they get to retirement? And so we're going to have all these demographic shifts that society's going to need to deal with, which, by the way, all these problems present huge opportunity for people that want to solve those problems. And if you want to be an entrepreneur or a business owner, the way you move forward and the way you succeed is through solving real problems. And so perhaps it's a nice way to finish the discussion, but ultimately, if you want to add value, the way you add value is through solving problems and being really focused and disciplined around how you do that. And at least that's been my experience. So
providing AI doesn't continue to get so good to the point where it's making all the best decisions for us and telling us which problems to solve. And I've seen some of those case studies pop up on ChatGPT, people saying, what business should I start? Now give me the roadmap. What tasks do I need to
there can only be so many custom t-shirt businesses out there, Steve. I'm pretty sure that that market will be exhausted soon, although I did want to have a crack at one myself one day. But
well, you do have a custom t-shirt on for Parpera, so we might leave this conversation here, mate. But I do sincerely hope that Parpera can become a case study similar to that of Slack, which evolved from a failed video game called Glitch, similar to that of Twitter, which evolved from a failed podcast platform called Audio. And maybe 10 years, 20 years from now, people in business schools and startup accelerators will be talking about Parpera in the same way that they talk about Twitter and Slack. So, of course, if people want to learn more about Parpera, they can do so over at parpera.com. And if they wanted to connect with yourself, Dan, where's the best place to go?
You're welcome to find me on LinkedIn, Daniel Cannizzaro, or just email daniel@parpera.com. Steve, it's been an absolute pleasure to feature on the show. And look, message to everyone out there that might be running a business or going through a tough time, just stick at it. You'll get through it. So thanks a lot for your support and looking forward to keep you updated.
Perfect. That's a beautiful place to end this conversation. Thank you so much, Dan.
Thank you.
Done. Sorry, we went 10 minutes over. Hopefully,
no, it's okay. There's probably I don't know. You can look at it and think about how you edit it or whatever. But